Hi, Steve Van Metre here, and welcome to your weekly economic update where we take about 15 minutes every Friday to try to make sense of markets that still don't make a whole lot of sense. Now, tonight I want to talk to you about why I was wrong in 2016. I know you don't hear too many people admit that, but I have admitted that I was wrong, and why I'm going to be right now. And I do want to say I appreciate, those of you who are my clients that, check in with me maybe every once in a while. Send me an email like, are you sure? Hey, I'm concerned about this. If you understand why I produce these videos, why I write to you every week, it's not just for me, although it does help me tremendously as I dig through my research. I mean, I don't know how many other financial advisors out there do the level of research I do, but I do it so that you can look at the research and try to understand it. And then I realize some of these concepts are fairly advanced, but I want you to look at it and say, hey, is he right this time? Or is he wrong? And we're going to go through another 2016 event where the market goes up and we're mispositioned again. Because if there's something I'm not seeing, and I'm not saying I'm saying that's entirely possible. Send me an email, say, man, you're totally misinterpreting this data. This is what I think. And I will look through it. That's what this is for. And you should feel that you have the right to do that. And so that's why I go through this, because I want you to really understand that the system isn't worked the way everyone thinks it works. But when you start to dig into the foundation of how the monetary system, and I'll go through some of this again in a moment, and how it relates to the asset markets, the stock market, the real estate market. When you take that time, you really start to learn how the underlying system works. And after 2016, where I was wrong and really wrong for over 3 years, technically I'm still wrong at the moment, but not much longer. Soon I will be very, very right. It's not fun. It is absolutely not fun. And so my commitment to you was not just to say, well, I'm wrong and let's go try something different, was to really figure out why I was wrong so we could be right and so we don't make the same mistake twice. That was my commitment to all of you. So I'm going to go through this today. It may be a long update. I don't know. I don't have any roadmap. I'm just, every video I do while it's pre-recorded is completely off the cuff. So if it seems like I might go over here and go swing around somewhere else and come back, just work with me. My dad said today at lunch, he said, hey, I know these concepts you're going over pretty advanced. Can you kind of bring the level down a little bit and maybe use some more analogies and try to explain it in a way, so people can understand better. And so I'm going to work on that today. And I will repeat it again. So I not only do the videos for those who are visual learners, I do the audio for the audio learners, and I do the written part for those who prefer that. And if you do all of them, maybe, and I'm not suggesting that you can't figure it out right away, but maybe over a course of several weeks or months of seeing this and getting kind of hearing it go in, it starts to make sense. And if you don't think I lay in bed at night going through these cycles and saying, okay, is this how this works? And this, I do. Because this is really important to me. And you are all really important to me. And getting this right is so important because once we get this right, we are the smart money. We are in the right place. And it gets really hard to goof that up. So let's go back to 2016 where Steve was wrong. Now, the global economy almost entered a recession. The data suggested that, but there were two factors that kind of pulled this thing out. One was China injected a lot of currency reserves into the global economy, and they no longer have those. So that's not happening again. In fact, I've seen some data from China, not even close. They do not have the ability to do that. The other aspect or other reason was the Trump effect. That's pretty much what everyone seems to fall back on. Well, when Donald Trump became president, it really changed the narrative. But underneath that, there was really something else that happened that may have made the election of Donald Trump more of kind of like a spark that, the fire was burning, but maybe just dumped some gasoline in it and just really got it fired up. It could just be that. I'm going to show you. What I missed in 2016 wasn't the injection of liquidity by China. With liquidity, I mean dollars. It wasn't the election of President Trump. It was the fact that 30-year interest rates hit their all-time, or revisited their 2012 all-time lows, and there was still pent-up demand. After 8 years of economic growth, there was still pent-up demand, and much of that was unlike other recoveries. I think a lot of Americans didn't participate, apparently, in the early stages of recovery, maybe in the first 6 years. So still after 8 years, which is normally the end of most economic cycles, there was still pent-up demand, and the low interest rates spurred that demand. And I'm going to show you some new data that we've never looked at before that will validate everything I'm about to tell you today. And it's not only completely convinced me that I'm 100% right, I'm hoping it will convince you as well. All right, so from there, from 2016 on, for reasons I can't quite explain to you, I started studying the monetary system. I think it started because a really smart macro guy told me, hey, go read this book on monetary policy. And I did. And then I started finding people out there who knew something about the monetary system. And what is the monetary system? It governs or regulates all those US dollars that float around the world. And since we are the world's reserve currency, unlike other countries where their native currency kind of mostly is within their borders, dollars go all the way around the world. So I started studying it, and there's a couple of things I found out. One is most people actually that think they're experts aren't. Two, there's only actually a few real experts, and they really do know what they're talking about. And number three is if you understand the monetary system, it explains so many things. And it tells you, positioning wise, whether you're right or wrong. Okay, now let me think about where I want to go with this for a second. All right, so like I said, there's a lot up there that's trying to come out, no specific order. So kind of work with me. Think of the monetary system. Again, it's dollars in the global world reserve or global currency. Think of it as blood inside your body. If that kind of makes you feel gross, think of it as that and someone else's. But the monetary system self-regulates. So we don't think, right? There's never a day I wake up, I'm like, man, do I have enough blood today to get through the day? Like, oh man, do I need to go to the blood store on my way to work and top off? Do I need to, like a dipstick, check and see if the level's right? No, we don't do that. Our body takes care of it. We don't think about it until something goes wrong, or for some perhaps intended reason, like we go give blood, that we don't have enough for a little while and we feel the effects of it. So our internal body self-regulates just like the monetary system. But one of the problems with our monetary system, we have this thing called the Federal Reserve, which is in charge of it. And they think they know better than it. And they're constantly trying to monkey with the monetary system to achieve a desired outcome. And they get in the way of it working. So as we look at the monetary system, it does a very, very good job of telling the world, the Federal Reserve and investors, us, when it's got problems. So recently, we've had what's called an inverted yield curve. This is where long-term interest rates, which normally should be higher than short-term rates, actually fall below short-term interest rates. This happens since 1971, when we went off the gold standard. Now, everything that I'm going to tell you relates to 1971 and after. There's always an inverted yield curve before a recession, 100% of the time. It doesn't give you a very good time. It could invert, and it could be a year and a half before there's a recession. But it always signals a recession because it's not natural for long-term rates to be below short-term rates. Now, why does this happen? Because if you're asking, that's a very good question. Because what the Fed does to create the problem is they tighten monetary policy, or translation is they draw blood out of your body. So it's either they're limiting how much it can create because they think, oh, it's creating too much, so we're going to throttle it back, or it drains blood out of your body. So imagine saying you had 10% less blood tomorrow. Yeah, you're going to feel tired. Maybe not even able to get out of bed. I really don't know enough about the proper quantities to give you proper explanations, but you get the idea. Anyone who's lost blood or given blood knows that fatigue, the more you're down, the worse it gets. And maybe 10%'s deathly. I don't know. But I want to give you that relationship. So the Fed slows the creation of dollars or drains or reduces a number of dollars out of the system. In a fiat-based monetary system like ours that expands based on the expansion of debt, so our monetary system gets bigger as we have more debt, it needs a constant supply of dollars. And it needs that for one very specific reason. There's never enough dollars in the monetary system at any given time to pay all the debt. It's not possible. If everybody that held dollars went and paid their dollar-denominated debts, there would still be debt and then we'd have $0 available in the system. So the monetary system knows that, and so it constantly needs to create more dollars, much like our bodies are constantly creating blood to make sure the system can run. Unlike our bodies, there's a balance of what it needs to create. In the monetary system, it constantly needs to expand the number of dollars in the global economy, constantly. When the Federal Reserve slows the growth of dollars or contracts the growth of dollars, then problems start to occur. And one of those is in the form of an inverted yield curve. Now, most experts will tell you that an inverted yield curve is a short-term interest rate problem. In fact, the Fed thinks so as well. What I'm going to convince you today is it's actually a long-term interest rate problem. So what happens is when there's not enough dollars in the system, the monetary system itself says, hey, I'm anemic. I don't have enough dollars. And gosh, these Federal Reserve people are keeping me from getting some. So I'm going to try to create my own. Now, again, I mentioned that people say, including the Fed, well, of course, the Fed thinks the inverted yield curve is a bunch of hokey pokey. It's not. It legitimately is a giant red flag. But the Fed sees this as a short-term interest rate problem. So what this comes back to is how money is created in our monetary system. Now, a bank, for every $1 in deposit, can lend against that 9 times. And it can be $1 in deposit, or it could be a reserve asset, such as a U.S. Treasury security they could hold, and they can lend against that 9 times. The Federal Reserve, by law, cannot create money. Congress cannot create money, and the president cannot create money. Only the banking system can, and only when people borrow. When someone takes a loan out, brand new money enters the economy. The banks essentially, you'll hear the phrase conjured out of thin air, kind of like a magician, and it enters the economy. The interest on the loan stays in the economy. As payments come back on that loan, the principal payments are destroyed or removed from the system and the interest stays in the system. That's how it works. So when we have an inverted yield curve where long-term rates fall below short-term rates, the Fed sees this as a short-term interest rate problem. Not immediately, but they eventually think so. And most investors do. But I'm going to suggest to you it's a long-term interest rate problem. And let me give you why that is. So if your body is starved for blood, right? What does it need? More. So you go down maybe to the blood bank, that's probably as good as an explanation, and you get some more. Now, we don't do that, but let's just say that you were short. Where are you going to go? Well, you're going to go to the place that has it. Now, the Fed is saying, oh, you just need a little bit. Here, just take a little bit. And your body's saying, no, man, I need a whole bunch. I'm down to like a pint, or who knows? I don't know. Maybe that's too much. I'm down a bunch. So if you look at this from a money creation standpoint, lowering short-term interest rates to get people to go borrow on a short-term basis, say 1-year loans, does not create much money, right? Because let's say I go down and buy a new computer and I can't afford it. So I borrow the money for 12 months. And maybe I pay fairly high interest rate. Maybe I borrow $1,000 and I pay 10% interest, and we'll just use simple interest because I don't want to pull my calculator out. Let's just say I pay $100 interest. Does that really create much money in the economy? No. In fact, to create enough money to equal, say, a $300,000 house, I'd have to go buy 30 computers, which I don't need because I can still only figure out how to use maybe one at a time. I suppose I could plug the other ones in somewhere, but I don't know exactly what they do. So the monetary system, as it gets starved and choked for blood and it needs that money, it looks to the system and say, how do I get the most money the fastest, right? If you were short blood, what are you going to do? You're going to go to the place that has the most of it and get some. And what is the biggest money creator in the economy? And I just said it. It's the housing market, right? You and I are, as consumers, the biggest single purchase most of us will ever make in our lives are our homes. And most of us, I'd say by far most of us, cannot afford to go buy and pay cash for homes. Or at least if we can now, we couldn't do it when we first entered the housing market. So we have to borrow it. And when you borrow a big chunk of money, it creates a big injection of dollars into the monetary system. So an inverted yield curve, the reason long-term rates start to fall is because the economy is going, look, man, I need some dollars. And I need a lot of them, and I need them now because these people over the Fed think they know better and they don't. Does that start to make sense? The problem is the Fed is propping up the short-term rate market saying, oh, there's inflation. There's going to be inflation. We got to keep interest rates high. And these long-term rates come down. And then everyone thinks, oh, the system's wrong. Long-term rates need to go up. No, the answer is long-term rates need to go lower. So, but they're really low. Yes, and that's why I've said interest rates are going to zero. They are too high. The monetary system needs to create so much money because of what the Fed did. It's going to drop long-term rates because, look, if everybody in this country went out and bought a computer tomorrow, that's not going to create as much money as everyone went out and bought a house. That's the difference. So the first red flag we get is an inverted yield curve. The second red flag that doesn't always happen, but happens when the Fed tightens for too long, is a contraction in world dollar liquidity. And essentially what all that shows us is the Fed is actually destroying currency. This did not happen in 2008 or 9. It did happen going into the dot-com bubble. So in 2008 and 9, they slowed the growth rate of dollars to the point the system broke. In 1999, they contracted the amount of dollars until the system broke. That's happening now. Now, I've never heard the Fed mention world dollar liquidity, so I assume they don't know what it is, but that's red flag number 2. When you destroy dollars in a system that needs to constantly create dollars, you have a problem. Imagine if your body stopped creating blood tomorrow. You would have a serious problem. You would need blood every day. Or if your body said, hey, you've drained me down so far, I don't have enough resources to create more. You need to bring me back up to a certain level so I can do it on my own. That's what world dollar liquidity tells us. The Fed destroyed too many dollars, and they're still destroying them today. Red flag number 2. The third red flag then, so at this point there's a lot of stress on the monetary system because what is the monetary system trying to do every day? Support your asset prices. It's trying to make sure your home stays at its current value, your stock prices stay at a current value. It's trying to make sure everything stays as it is. But it can't when you drain the amount of dollars out of the system. So it tries really hard. And it tries to do that by lowering long-term interest rates. It tries to do that by flagging world dollar liquidity as a contraction. The third way it says the red alert, and this is like cancer, like terminal cancer for a monetary system, you have a problem in the overnight, what's called the overnight repo market. And this means banks are short money. And they need what I would call an overnight payday loan. They come to the Fed, knock, 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 hey Fed, I need some money. I'll pay you tomorrow. Fed goes, yeah, all right, here you go. And oh, by the way, I want some collateral in the form of either a U.S. Treasury security or a mortgage-backed security. I'll hold them, I'll give them back to you when you pay me back tomorrow, and I'll charge you a small amount of interest. When the monetary system gets to the point where you need overnight cash flows or overnight loans, it's too late. This did not happen in going into the great financial crisis. It did happen going into the dot-com bubble. And at this point, the monetary system is effectively broken and is dying. And it's saying, look, I want dollars. I can't get them. So if you don't give them to me, like every day, I'm going to die. So to give you an example, it would be like, hey, you're low on blood. So I come over and I'm like, here, Give you some more. And you call me next day, man, Steve, what? I'm low on blood again. What? So I come back over, I check. How'd that happen? Where'd it go? I don't know. Injection again. All right, good. Topped him up. He's good to go. Third day, you call me up. Steve, no. Yeah, I'm short again. How's this possible? That is a giant problem. That says the monetary system is failing. There is no coming back from it. When you get to this stage where you need overnight or short-term liquidity injections from the Federal Reserve, it's done. The only thing that's left to happen is investors to realize that this is a serious problem and the system is failing. Now, why do these injections mean anything? Why doesn't the Fed just say, hey, sorry, banks, you're too bad, you're on your own? Because again, there are not enough dollars to pay on all the debt. So when the banks are coming to the Fed and saying, hey man, we need money, what they're really telling the Fed is, hey, some people are going to default on their loans. It's going to be bad. And the Fed's like, uh-oh. Because when you start getting defaults in a debt-based monetary system, you get recessions and depressions. The system fails. So the Fed gives them money thinking that the problem is short-term in nature because these are overnight loans. What I want you to understand here is these are not overnight problems. They are big long-term problems that are not being dealt with because the Fed doesn't understand that. So what happens is long-term rates come down. And then all of a sudden, speculators come into the market and say, wait a minute, long-term rates are cheap again. I'm going to short them. So I'm going to bet against rising interest rates because I made that bet in 2012 and I made money. I made the bet in 2016 and made money, and I'm going to do it again. But there's one key thing that you can go look at, and we're going to do that, is when you see low interest rates. Remember what I said in 2016, what I got wrong. See, this is coming back to where I was wrong. In 2016, low interest rates created economic growth. We can actually go look at that. We're going to. I've got some new data I found. It was sitting right where like a couple of rows under some other data we'd look at. But what it's telling us now, in fact, what it tells you is when you see low interest rates or near all-time low interest rates and there's no economic growth out of it, where there's no money being created from it, game over. And so the reason I've shown you charts and data and written about how long-term interest rates are going lower, it's because they need to go lower to get people to take big loans out. For example, I ran some numbers on a $325,000 home on a 30-year mortgage, assuming the whole thing was borrowed. At 0%, so I based it on prevailing rates and national average, and I ran it at 0. It takes a payment from $1,460 a month, principal and interest, to $900. Now, why would that be relevant? Well, for all of you listening that have millennial children, would that get them to go buy? Yeah. Because now all of a sudden at $900 a month, you've got a rent equivalent. And now if you got a bunch of millennials coming into the market, boom, you've got some money being created. And maybe you have some other people my age, Gen Xers, and man, I need to fix my yard or do some other stuff. I can do a cash out refi and keep my payment the same or even lower it. And maybe there's even some boomers that got some stuff going on they need to take care of. And they go, hey, at 0%, I could cash some money out and still have a lower payment. That's why the long-term interest rates are trying to go down. But what you have is the Fed keeping the federal funds rate, propping it up, and then you have speculators betting that it's going to go up. But the data says that the drop in long-term interest rates isn't working. It's not creating growth. It's not creating any new money. It's not doing anything. And when you look at that, when that happens, game over. The monetary system will continue to fracture and break until it shatters and drops long-term interest rates down because the monetary system's self-healing. Do you know where it will get that money from? It will pull money. There's two things that happen. One, it'll bring asset prices down to the amount of dollars in the system. The second thing it'll do is it'll pull people out of their risk assets, i.e. stocks and the people that are short, and force them to buy bonds and drop interest rates down. Now, those that understand this, which is now you, who are also the smart money, the large commercial banks who are intimately involved in the monetary system, foreign central banks who are intimately involved in the monetary system, and securities dealers who are owned by large commercial banks have all been buying bonds because they know what now you know, is that the Fed is focused on the short term. So as the Fed lowers short-term interest rates and does quantitative easing, which they don't want us to call what they're doing quantitative easing. It's actually called POMO, permanent open market operations, whatever. It's QE to you and me because that's what you understand. What you see is long-term interest rates will go down as the Fed does more of it. And the market says, no, when Fed does QE, long-term interest rates go up. No, not when you're at the end of the cycle and it's not generating money, because when long-term interest rates go up right now, growth stops. It's stopping even faster. And when the monetary system does not get the dollars it needs, it will break. Does that make some sense? The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recognition or solicitation by or selling security, financial product, instrument, or to participate in any particular trade strategy. This video is prepared by Steven Van Metre on personal capacity. Opinions expressed in the video or that of my own do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So again, think about this tonight. If you were starving or needed blood, what are you going to do? You're going to go like, well, I'm going to go to dinner at a place that has a tasting menu because I haven't eaten in a week. No, you're going to go to the buffet and you're going to get plates full of food. Blah, 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 blah. That's the idea, is you're starved for money. The system is starved. It needs it. Now, let me show you where. Let's go through the data, and I'll get to the slides on that because it is important. Now, what's odd is the money supply is rising. It's having no effect. Look, here again, here's some more data for you. The Fed's done 2 rate cuts, has done $200 billion in overnight repo loans or short-term loans, and has now done 2 days of QE equal to $14 billion. And what have we not got? No new all-time highs in stock market, no new all-time highs in Treasury yields, and no economic growth from it. What do you think is going to happen at the end of the month when the Fed meets and they're forced to cut rates? They told you the last 2 cuts were mid-cycle adjustments. They're not. The monetary system is telling the Fed, you are choking me to death. If you do not lower interest rates, you will wake up one day and find out your little overnight repo problem is to the tune of hundreds of billions of dollars or $1 trillion. And then you'll lower interest rates to 0 so I can bring long-term interest rates down so I can get the money I need. That's why long-term interest rates go down in recessions. I'm going to show you every dime. I'll show you again. And the biggest return an investor can make is by taking as much risk as they can possibly stomach going into a recession by buying the longest maturity bonds they can afford. I've tuned the portfolios that way. The low risk portfolio should generate like a 30% return. The mid range about 40. The high risk around 50. This happens in a matter of weeks, like 4 to 6 weeks. And right now we're facing some short-term volatility. I told you we would because I don't know what day it's going to break out. I don't know what day we're going to wake up and the news is going to be like, there is a massive problem in the monetary system, and boom, it happens. We can't play chase. We have to be in ahead of time. Have to. Because guess what happens when we make that return? Not only are we going to be super psyched, right? We're going to be like, hey, we're the smart money now. But stock prices are going to crash and we're going to turn around and buy stocks low. We just got to work through this. But let me show you the data, because you should always question what I tell you, because I question every day. Am I right or wrong? Because I need to make sure I'm right. Growth rate increased on the money supply to 6.47. This is not helping the economy at all. The 6-month rate of change is at around 4. 3-month rate of change is at 2. This should start to slow down as we now enter the October data. But the reason I figured out that this repo problem, this overnight loan problem, was a long-term rate and not a short-term rate that triggered this massive research binge to conclude what I just shared with you was this chart right here. Somebody online started tracking the overnight amount, the amount of money the banks were borrowing. There's 28 banks, US, European, and Japanese banks that can participate in this. And I looked at this chart, and you're going to think this is totally weird, but I looked at this and I was like, I've seen this before. It's 10-year Treasury yield. And then it hit me. Wait a minute. The repo problem is not a short-term problem because short-term interest rates haven't gone up. But long-term rates have, and every time long-term rates go up, who's knocking on the Fed's door? The banks. And everyone's like, hey, there can't be a short-term. No, it's a long-term interest. And then it cued off this whole monetary system like deep dive, because when you understand the monetary system, You know if you're positioned correctly. We are positioned correctly. It's crazy when you start understanding this stuff. So here is the best way to figure out how the interest rate market affects economic growth. So I went and pulled all the real estate loans at all commercial banks that are in blue. This is a total dollar amount, and I ran the year-over-year rate of change going back to 1971. Then I pulled the 30-year fixed mortgage rate. Why the 30-year fixed mortgage? Because most people take out 30-year mortgages, so it was just that's just the way we're going to do it. And let me show you. Now, the key thing is, prior to 1980, we were dealing with inflation, so this doesn't look quite as good as since 1981. But when you have a currency devaluation, it does throw this off a little bit, but you can still see signs of it there. So let's take a look at what happened starting with the 1987 recession going forward. So you see in red, interest rates went down during the recession, but look what happened to the total dollar amount of loans. It also, the growth slowed. This doesn't mean that the amount fell. It just means the growth rate showed. This is a year-over-year rate of change. So interest rates fell and the growth of real estate loans fell. Now, if you're saying, what's that green line there? That is the average that the monetary system needs to see in growth of real estate loans since 1971. I hope you're sitting down. The average growth rate in dollar amount of real estate loans to keep the monetary system humming along nicely, 9.1% per year. Historically, 9.3%. It's like I didn't actually believe it was that big, but that's what the real number is. So that's what the growth rate needs to be. Let's go back and look. So interest rates went down, and then boom, look what happened. Finally, they went down enough that it spurred growth in the mortgage market, and then went up and it started to slow down. Now, why did interest rates go up? Because the monetary system have interest rates start to go up to soak up some of the money created by the mortgage lending. See, the monetary system is self-regulating. Then, as it slowed down, what happened? Interest rates fell and boom, kicked off a growth. I mean, mortgage debt was growing at 20% a year. And now, as we get into the late 90s, look what happened. Interest rates started to flatten out. So mortgage demand or growth and mortgage loans fell. And I don't mean, again, total dollar amount of mortgages. That includes equity line of credits and closed-end multifamily units as well. And you see the growth rates slow down a bit. But look what happened. The monetary system said, hey, we're not growing enough. And interest rates continue to fall. And look what happened. The growth rate of loans fell. And what does this tell you right here? Alan Greenspan, Fed chairman, over-tightened monetary policy to the point where lower interest rates, were not driving more demand. It was having the opposite effect. So here you see the recession. Look what happens. Interest rates fall. They continued to fall until mortgage demand picked up. Now all of a sudden the system's working again. Remember, the monetary system said, look, I'm going to force you to lower rates until it works. And they did, and it worked. And then interest rates went up to start to soak it up. It slowed it down. And all of a sudden growth went down. So interest rates went down, and boom, there you go. It worked again. And then it slowed it down as interest rates went up. So it was still telling the monetary system was still saying, look, interest rates still too high, still need some more money here. And then look, interest rates went down, and now it really got ramped up. So late cycle now, boom, we get up to this big, 17% growth rate per year, which is impressive. And so the monetary system drove interest rates up to slow the growth down. And all of a sudden, it really slowed it down. But look what happened. Growth rate went down. And interest rates went down. Boom, there's a recession saying, nope, the monetary system wasn't getting what it needed. Oh, wait, you know what? Alan Greenspan wasn't the Fed chair here. Alan Greenspan was the Fed chair here. I don't remember who was Fed chair. It doesn't matter. Alan Greenspan so what this saying is, again, Alan Greenspan over-tightened, and they lowered interest rates down. The monetary system forced the Fed to lower interest rates until long-term interest rates were low enough to spur mortgage demand over that 9% rate. Notice this is you'll notice the system's happy when it's up in these ranges. See, when it starts to get up here, the Fed starts to intervene, and all of a sudden, no, the market says, I want growth over 9% or close to that. Let's continue. Interest rates start to rise, but it's early in the cycle in 2000, causes growth rate of mortgages to fall down to 10% a year. The monetary system's not too thrilled about that, so it has some undulations here until it goes down enough that it gets it going again. And then the monetary system raises interest rates to soak up some of those dollars. It slows the growth rate down. And then all of a sudden the monetary system, because again, Ben Bernanke now over tightened monetary policy, the monetary system starts to drive interest rates down to create money because the Fed over tightened and the growth rate falls and boom. And look, interest rates have to go all the way down and keep going down to drive this up. And now at this point, it's contracted. This is the first time we see contraction in lending. So interest rates had to go to new all-time lows. You'll notice every recession, new all-time low, new all-time low, new all-time low. This is very important to understand. Long-term interest rates have to go to new all-time lows and stay down there long enough to get people to go borrow and spend. Do you see how cool this is? Because when you see this, you go, oh man, I want to take as much risk buying bonds as I can if you're about to show me what I think you're about to show me. And I am. Let's go back. So interest rates go down, demand goes up. Interest rates go up, slow down demand. As we get into 2016, this is where the economy almost hit a recession because even at all-time lows, demand started to roll over. And interest rates went up, so Steve is now here officially wrong. President Trump gets elected, China injects currency. Interest rates rise, it starts soaking up some of this demand. And now, all of a sudden, interest rates are back pretty much at the cycle peak, and demand is running about 4% a year. Still way low. Notice it never got to the 9. Here's how you know you're at the end. Interest rates have gone back to their all-time low, and residential mortgage growth is at a little over 3% a year. This drop in interest rates did not spur any increase in demand. Now, you probably said, well, where did you get that from? Good. You should ask those questions. I will show you. Let me get that loaded up. Here, Fed Reserve H.8 report that we look at every week. And let's see here, total real estate loans right here. And you go, well, yeah, well, you have the weekly data. Yeah, I do, actually. So here it is. I download the weekly data. My wife, who's listening to this, will go, oh, I didn't realize you got that. Last night I told her I could only find the monthly data. I got the weekly data today, and I put it into my system. So let's go back to 2016, where Steve was wrong. Here's the 3-month rate of change, 6-month rate of change, 12-month rate of change. So you've heard me say that the 12-month rate of change can be misleading because 3-month rate of change can be rising or falling, right? So you're probably like, you better have checked. Of course. So you see the 3-month rate of change in 2016 was running fairly hot. It got up to over 2% a year and was staying at 1.7 to 1.8, fairly strong growth. Now, let's go look at where it is today. As of last week, the 3-month rate, so here, 12-month rate of change is growing at 3.33%. 6-month rate of change is validating that. Double 6-month, you get 3. But look at the you get the 12-month. Look at the 3-month rate of change. This is 0.72. And it's been since, where did interest rates peak? In October 2018. So look, at one point, we'll highlight this for you. It looks like it's starting to work as the quarterly growth rate gets up to 1. Here it is at 1. Here it's at 1. Nope, not working. It's down to 0.72. It's slowing. It's at 4 times 7 is 2.8. So there's your annualized rate. It tells us that the 12-month rate of changes had lower. It goes further, tells us that there is no growth coming out of these lower interest rates. It's not working. So there's your evidence. Pretty cool, right? So let's do the math. You've got inverted yield curve that the Fed thinks is a short-term rate problem. You got contraction in world dollar liquidity saying the monetary system validating that the inverted yield curve is telling us that the monetary system is starving for money. You've got overnight repos that are saying, look, the monetary system has cancer. It's breaking apart. It's going to die, and it's going to self-heal by breaking the global economy until it gets what it wants. And when you look at the growth in real estate lending, it tells you that lower interest rates aren't working. You've got, there it is. All 4 are saying we're about to have a massive recession. The monetary system is going to break. It's going to flush all these speculators. Now, speculators are currently short Treasuries on the 2, 3, 5, 7, 10, and 30-year bond. You want to know why bonds go like, bond prices go like that? Because all those speculators get flushed out, and then the retail investors who are never owned Treasuries going into recession panic, sell stocks because they're going down, and buy Treasury bonds. And all that money floods in, causes interest rates to go down until the monetary system gets what it wants, and we make a bunch of money because we're properly positioned. Now, if this data here was showing growth, let's say that 1% was hitting 1.5, 1.8, then we go like, uh-oh, we're in the wrong place. Got to get out. No, this is saying that is the checkpoint. That is the validation that says, yes, we're in the right place at the right time. We just have to just stomach through the volatility. Pretty cool, huh? I hope it makes sense. Let's go on. Commercial industrial lending. This is the other big form of lending. Why do we look at this? Because who borrows a lot of money? Consumers when they buy houses, and when companies borrow money. The growth rate on commercial industrial lending fell to 4.85 over last year. But look at the 6-month and 3-month rate of change, negative. There you go. So again, the big money generators, along with real estate, is not creating enough money to supply the system with dollars. It's breaking right in front of you. How about credit cards? Fell again, 3.61%. This is slowly falling. So consumers, not that they can charge on the short term, that's not working. How about the University of Michigan household durable, good time to purchase, inverted against the unemployment rate? So right now, people are saying it's not a good time to go out and buy large durable goods like washers, dryers, TVs, and spas and other things like that. Why? Because there's not enough dollars in the system. And eventually, leads to layoffs. It's saying the unemployment rate should be over 5%. Cash freight shipments are suggesting that GDP growth could be near zero. So subtracting government expenditures, which are the largest, highest level contributions, produces a second quarter GDP of only 1.1%. Third quarter could be zero or close to it. Wouldn't that surprise the market? How about CEO confidence? If you were a CEO of a big major company, you would already know this. You know when the Fed is doing overnight repos that there's a problem because you see it in your own internal data. CEO confidence leads the factory sector by a quarter, suggesting that this drop in factory print that we look at is not short-term. It's going to get worse, and it would make sense. For the first time since 2008, as of this last month, industrial production in the United States is now negative. It joins Germany, United Kingdom, and Japan. The last time all four were in contraction was the great financial crisis. The last time before that was the dot-com bubble. From Northman Trader, he said, here's the inverted yield curve, signals the bull market is soon to end. Here you see inverted yield curve, bull market starts to peak, yield curve, bull market starts to peak, yield curve, bull market starts to peak. Why? Because what happens is the Fed has to lower short-term interest rates, causing long-term interest rates to go down. You get a short squeeze of those bondholders that are the speculators are short bonds. They have to cover their shorts by buying bonds. Now, where do they get their money from? They don't have any because the money's there's not a lot of dollars in the system. So they go and sell some of their stocks to cover their bond shorts. But the problem is they're short volatility. So when they sell their stocks, volatility goes up and they start getting squeezed on their vol shorts. So what do then? They have to sell more stocks to cover their vol shorts and then cover their bond shorts, which are now getting killed. And all of a sudden you get a feedback loop where bond prices are going up, volatility is going up, and the stock market is crashing because people are selling stocks to cover their shorts. It's going to happen. How about this? The yield curve predicts a decline in S&P 500 earnings per share growth. So here's the yield curve. Here's forward EPS growth. Everyone's saying, nah, the health of companies is good. This is saying, no, it's not. Not good at all because there aren't enough dollars in the system to keep the system running. CEO confidence is low as it was at every prior recession. All right, we've gone a long time. Let's look at some charts real quick. And then we'll, you know what? Shoot, I do want to look at that too. Let's look, you know what? Yeah, let's look at this real quick. Here's 10-year Treasury yields. Speculators shorted here in 2012 because they made money. Shorted here because they made money in 2016. otherwise known as the time Steve was really, really wrong. They're shorting here now. They're shorting because they think these low interest rates, like it did here and here, are creating economic growth. I just showed you they aren't. That's why you get this big spike, or this big, where is it, in 2000? This is what we're looking for, this drop right here that happened in 2008. The 6-week drop made bondholders a boatload of money because the monetary system broke, forced all those short sellers into bonds, and made bondholders really, really wealthy at that time. That's what we're doing. And for people to say, well, I think this is the bottom. No. Bottom is going to be close to zero. This is a top. So all these short sellers, so this pain that we're enduring right now is almost over. Because when we look at TLT, the 20-year Treasury bond ETF, let's zoom out a little bit. This pattern right here is what's called a continuation pattern. So we had a bottom between here and here. Then we had a rise out of the bottom. So it broke out right here. And it's consolidating. How do we know it's consolidating? We know this because it's speculators who are shorting these positions. And so the big players are letting the speculators short, and they're buying up the inventory. Consolidation patterns are continuation, meaning they do this before they go higher. Now, how do we know that? Is because we can go and take a look at what a top looks like. Oops, let's go to the weekly. Here's what a top looks like. It goes up, boom. Is this 2012? 2012, room, and starts to break down and go lower. Here's the 50-week moving average, not even close. Not the same at all. So when you get a true top, you get a massive sell-off because the smart money starts, it unloads and makes their profit. So this is a consolidation pattern because we're at the end of the cycle. Last thing we'll look at, and then we'll call it a night, is the monetary base. This will tell us if the Fed's policies are working. So here you can see quantitative easing 1 coming up here, 2 and 3. So let's zoom in. The Fed has now 2 rate cuts, $200 billion in overnight repo term loans, and $14 billion in permanent asset purchases. And last week they recovered $100 billion, and they've spent a lot of money doing that. $100 billion. If we look at this on a year-over-year rate of change, which gives us the closest thing to World Dollar Liquidity, because the Fed does not carry bi-weekly or monthly data where we can add foreign held treasuries. World Dollar Liquidity is still contracting at almost 8% a year. And it's been contracting since 2016, except for right here. So we're in the longest contraction of World Dollar Liquidity, courtesy of, you can see here was that brief contraction there. Well, we don't see it here. There's contraction, but this is a problem that will not get resolved now until there is a recession and long-term interest rates go down. So now you know why everybody that says that inverted yield curves is a short-term interest rate problem, wrong. World Dollar Liquidity, not a short-term interest rate problem. Overnight repos, definitely not a short-term interest rate problem. Now you know long-term interest rates are going to zero or negative, why we own them, and why we just have to just hang tight, because at the end of the month, the Fed's going to cut rates. And when the Fed continues to cut, people will panic. Because remember, 2 rate cuts were mid-cycle adjustments. What are they going to call the third one? A don't panic adjustment? Nope. So thank you for being patient. We're not very far off. We're a matter of a month or 2 away from realizing some pretty big gains and then being able to buy stocks cheap and following the smart money and doing things the way you're supposed to do them that no one else does. And unfortunately, it'll be sad to say a lot of people are going to lose a lot of money, but we're going to be great. And I wanted you to see that, and I wanted you to see the data, because I know some of you are nervous, and I wanted you to understand that we are absolutely in the best possible position we could be in. I hope you have a great weekend. I'll be back at you Monday so we can see how much the speculators shorted the market, the bond market last week. And I bet you they did a bunch, and that's great news for us. I'm Steven Van Metre. Bye now.